Hello there, my friends. Chris Marcus back here again with you today on Thursday, August 24th. Today, a quick update in the mortgage market. We had some interesting news yesterday, which seemingly came as a surprise to Wall Street, although when you understand what's going on, it's kind of thing that really have been expecting for years, and interesting to see it happen now, and we'll discuss what that could mean going forward. So, in short, to get to the punchline here, yesterday home sales data was out, and the home sales dropped 9.4% in July compared to June, which is a pretty big drop. The median sale price of a newly built home jumped more than 6% year over year. And, again, you always want to see more than a month of data, especially data that comes from the Bureau of Labor Supply, or I forget what the S stands for, but any of that government data, you want to take with a grain of salt. Certainly, hey, if things jump back next month, then perhaps that changes it. Numbers are often revised. Although, given that we're in the middle of a massive housing bubble, and interest rates, even though they've only gone up 1% in the last year, still, it's interesting to see that perhaps things are beginning to slow down. Again, mentioned the other day in a video we did about the mortgage market. I just anecdotally talked with a couple real estate folks lately, and they said things have finally been slowing down after more years of wild growth. And again, if you have interest rates go up, if the Fed stops printing money, well, this is exactly what you would expect. And we'll dig in a little bit here. Just an interesting, I was looking at the CNBC article. We will link to that one below. But just a few interesting nuggets they mentioned that comment on, and hopefully have it making a little more sense. So first of all, newly built homes are more expensive than they've ever been before. And again, as the price of housing keeps going up, you price people out of the market. But let's see, as we scroll down here a little bit more. Here's an interesting quote. The scars of the housing bust are still fresh in the minds of many home builders, so it is not surprising that many are taking a cautious approach to ramping up production, which certainly would make sense. At least here in Denver, it doesn't seem like anyone's been hesitating from ramping up production. The building you see going on here is pretty incredible. I think that's similar around other sections of the country and the globe. Continue to hear about wild real estate markets in Canada and Australia in particular. So as we continue down here, another interesting sentence. Home builders are feeling slightly better about their business lately, but they continue to complain about the costs of land, labor, materials, and regulation. We'll do a whole seminar on my thoughts about the regulation in this country and the reasons that I feel it puts a big crimp on commerce in general. But anyway, they claim that's why they can't build cheaper homes. And it's interesting to note costs of land, labor, materials, and regulation. Certainly, when you print $4 trillion following the past housing bubble, prices are going to rise. Now, I'll be first to admit that I'm surprised we haven't even really seen more obviously noticeable price increases. Certainly, if you go to the supermarket or buy food, which I think a lot of people do, you probably notice things aren't getting cheaper. And I think a lot of the reason why is that still a lot of the inflation is being exported. A lot of these dollars are going abroad, so it hasn't bid up prices of all goods quite as much, but certainly, as we just saw here, real estate prices have gone up a lot. And now hearing that the home builders, land, labor, materials, And certainly commodities, which we've seen a rise in, unfortunately not gold and silver, which again I would credit to the manipulative short position that some of the banks are basically writing paper contracts that they can't deliver. Yet we've seen in the past couple weeks a lot of the other base metals and commodities going higher in price, which most people don't think about, yet then you see reflected as input costs to companies like home builders. So let's keep going down here. A few more interesting quotes. Even luxury home builder Toll Brothers saw a significant drop in the average price of home delivered. All right. So at least someone's seeing some segment of the market is coming down. And that seems to be the main gist of this, which, again, with housing being such a massive portion of the market, it's just something worth keeping an eye on because, hey, whether it's silver exploding upwards or interest rates going up or mortgage prices going down, again, these are all some of the factors that when you have such a fragile economy that's based on money printing financing, at some point the party comes to an end. And again, just something to keep an eye on. For example, if we see a continued trend like this next month, perhaps we're getting, you would think at some point we're getting close to the end of the mortgage bubble. Again, keep in mind the old phrase that bubbles can go on longer than we can stay solvent when we're trying to capture these things, which again is why, however you're investing now, certainly if you're sharing a similar view as I am, that we have some bubbles and forces that eventually have to be reconciled, well, at some point it's going to happen. And certainly if the mortgage market plummets, if you start to begin to see something like 2008, which is exactly what you would expect if the Fed actually did raise interest rates and unwind its balance sheet. Remember, back in 2008, all these, when you hear the Fed balance sheet, they bought all these mortgage bonds that nobody else wanted to touch because, for the most part, they're probably completely worthless. So, A, if the Federal Reserve is going to start selling that off, I'd love to know who's going to buy it and how they plan to do that without cratering the market. If there's anyone on the planet who knows that, please write in a comment below because I sure can't figure it out. Which, again, is why you don't start printing money in the first place, because it inflates bubbles, and when you try and unprint the money, the bubbles crash. So, something to keep an eye on. We'll see if we're reaching that point. I mean, it's almost by the day, whether it's the political stuff, sanctions, nuclear threats with North Korea, antagonizing the biggest creditors to the U.S. government. Man, there sure are a lot of forces building that would indicate at some point that we're going to see a massive repricing of the markets. Wish I could tell you exactly when that will be, but hey, it's nice that we have the advantage of time on our side, and that's why I like structuring my trades in a way that I don't have to guess whether it's going to happen today or next year. But if you have silver or gold sitting somewhere or other inflationary assets that do well in an inflationary environment, or if you're not buying a house, but just not trying to time these things. That's often when we try and get a little too clever, which I've been guilty of in the past, doesn't always work out as well. But what I love so much about understanding these dynamics that are happening is that if you take a little bit of a longer term approach and leave the short-term flipping to some of the Wall Street junkies, I think it gives you the ability to go back to living and enjoying your life, doing whatever you do, and not being at the beck and call of the latest Wall Street cycles. So with that said, I hope you found this one helpful. Hit the subscribe button now We got some good stuff coming up, and we'll keep you covered and make sure you know what's going on before it happens. So hit that subscribe button, and we shall see you again tomorrow, my friends.